one of the easiest things to do in the lab is to create bubbles. Bubbles are all about people looking at signals from other people and giving them too much weight. And very easy to create bubbles. And then of course fear. It's very easy to create fear. So the stock market has lots of ups and lots of downs. People read things into these ups and downs and therefore make mistakes. And another interesting thing is that we are really bad in reading randomness. So the stock market has a lot of randomness, but we as people, we don't see randomness. Like you look at the stock market, and you feel like you have to tell a story. Do you have here people who talk at the end of each day about what happened in the stock market?
Yeah, sometimes.
You know, their stories always make sense, but it's always in retrospect, right? So we're good storytellers, and the hardest thing in the stock market is to have the discipline to put money away and to be counter-cyclical. If you reduce your irrationality, you'll make less mistakes. There's no question about it. You know, one of the mistakes in the financial market is due to what we call anchoring. Anchoring is the idea that you remember past decisions and you make your decision based on them. We find that people hold on to losing stocks too much. You bought a stock at 100, it went down to 80. You don't feel like selling it because you feel like you've lost money. So you keep the stock with the hope it will go back up. But if it's not a good stock, you should sell it and continue. So in the stock market, there's no question that understanding, being more rational is better. But let's say that you're not just in the business of investing, you're also in the business of advising people. Right? You want to be a financial advisor. Now, if you don't understand things like trust, which are inherently irrational, and you don't understand fear, you're not going to be able to advise your client correctly. So I would say that you want to understand the irrationality of others, but you want yourself to be more rational. The financial crisis of 2007-2008 was different because people said, I couldn't have known. This was something that was architected by Wall Street in some terrible way. That financial crisis basically said to us, nobody knows what's going on. You don't know what's going on. Lots of people in Wall Street going on. We created a beast that nobody understands. And it created a tremendous amount of fear and hesitation. So what you saw is when the crisis started, lots of people pulled out of the market. And then lots of people stayed out of the market. Like they have not regained the trust of the market. And of course, lots of older people, sadly in the US, took the money out on the way down, did not put it back on the way out, and they lost again on both sides. So I think that one of the big unresolved issues, I think, has been the erosion of trust in the markets. And we haven't done much. I mean, the markets are back up and so on, but I don't think we've done anything to deal directly with this issue of mistrust. And I think until we do it, the small investor is not going to be as willing to participate in the market. What I do know is that the main function of the stock market is to provide liquidity to companies for long-term returns. That's what the market is about. And I think that we have kind of forgotten that. And there's too much in the market that is about day-to-day news. But I do think we need to remember that the real function of the market is about long-term return, and we need to focus on that and stop the focusing on short-term fluctuation. Even the news, right, reporting the daily fluctuation. Right? It's either randomness, it's randomness and a distraction rather than thinking long term.